The Anatomy of Modern Ponzi Schemes, Beyond Bernie Madoff. When Bernie Madoff's $65 billion Ponzi scheme collapsed in 2008, the world thought it had witnessed the ultimate financial fraud. But Madoff's downfall wasn't the end of an era. It was merely the closing of one chapter in a book that would soon be rewritten by a new generation of criminals armed with cryptocurrency, social media influence, and increasingly sophisticated deception techniques. While Madoff's name became synonymous with Ponzi schemes, dozens of other masterminds have emerged from the shadows since 2010, stealing billions from investors through schemes that make Madoff's operation look almost quaint by comparison. These modern fraudsters have weaponized technology, exploited regulatory gaps in emerging markets, and preyed upon investors' fear of missing out on the next big opportunity. From cryptocurrency platforms promising impossible returns to real estate moguls selling non-existent properties, the anatomy of the modern Ponzi scheme has evolved far beyond the traditional model of simply robbing Peter to pay Paul. The digital revolution has fundamentally transformed how Ponzi schemes operate, with cryptocurrency serving as both the perfect vehicle for fraud and the ideal method for laundering stolen funds. BitConnect, which collapsed spectacularly in 2018, demonstrates how modern criminals have adapted the classic Ponzi model for the blockchain age. The platform promised investors returns of up to 1% per day through its proprietary trading bot and volatility software, claims that should have raised immediate red flags among seasoned investors. At its peak, BitConnect had a market capitalization of over $2.6 billion, with thousands of investors worldwide pouring money into what they believed was a legitimate cryptocurrency lending platform. The scheme's operators, led by promoters like Carlos Matos, whose enthusiastic conference presentations became internet memes, used a combination of multi-level marketing tactics and cryptocurrency complexity to confuse and entice victims. When BitConnect finally collapsed, investors lost an estimated $4 billion, with many never recovering their initial investments. The platform's native token, which had traded as high as $463, became virtually worthless overnight, leaving a trail of financial devastation across multiple continents. Real estate Ponzi schemes have experienced a renaissance in the post-Madoff era, with criminals exploiting both traditional property investments and emerging markets like vacation rentals and commercial development projects. The Woodbridge Group, operated by Robert Shapiro, epitomizes how modern real estate Ponzi schemes have evolved to appear more legitimate and diversified than their predecessors. Between 2012 and 2017, Woodbridge raised over $1.2 billion from approximately 8,700 investors by promising returns of 5 to 10% through investments in real estate loans and property development projects. The scheme used a complex web of over 200 affiliated entities to create the illusion of a diversified real estate empire, complete with professional marketing materials, investor conferences, and even physical properties that served as elaborate props. Shapiro and his co-conspirators spent lavishly on personal expenses, including luxury homes, private jets, and expensive artwork, while using new investor funds to pay earlier investors and maintain the facade of profitability. The Securities and Exchange Commission eventually shut down the operation in 2017, but by then, investors had lost an estimated $650 million. Court documents revealed that less than 3% of investor funds were actually used for legitimate real estate investments, with the vast majority either stolen outright or used to perpetuate the scheme. Social media platforms have become the primary hunting ground for modern Ponzi scheme operators, who exploit influencer culture and viral marketing to reach victims on an unprecedented scale. The rise of forex trading schemes on platforms like Instagram and YouTube represents a particularly insidious evolution of traditional investment fraud, combining the promise of financial education with classic Ponzi mechanics. Individuals like Jonte Austin, who operated the first million social media empire, used aspirational lifestyle content to attract young investors seeking quick wealth through foreign exchange trading. Austin's scheme, which operated from 2017 to 2020, raised over $33 million from over 11,000 victims by promising returns of up to 15% per month through proprietary trading algorithms and educational programs. The operation relied heavily on social media marketing, with Austin and his associates posting images of luxury cars, expensive jewelry, and lavish vacations to demonstrate their supposed trading success. Victims were encouraged to recruit friends and family members through multi-level marketing incentives, creating a viral effect that allowed the scheme to grow rapidly across social networks. When the Commodity Futures Trading Commission finally shut down the operation, investigators discovered that Austin had actually lost money on nearly every legitimate trade he attempted, using new investor funds to pay existing investors while funding his extravagant lifestyle. The globalization of financial markets has enabled modern Ponzi scheme operators to exploit regulatory arbitrage, operating across multiple jurisdictions to avoid detection and complicate law enforcement efforts. OneCoin, perhaps the most sophisticated cryptocurrency Ponzi scheme ever devised, demonstrates how modern criminals leverage international complexity to build multi-billion-dollar fraudulent enterprises. Operated by Ruja Ignatova, who earned a PhD from Oxford University and worked at prestigious consulting firm McKinsey & Company, OneCoin masqueraded as a legitimate cryptocurrency while actually functioning as an elaborate Ponzi scheme that defrauded investors of approximately $4 billion between 2014 and 2017. Unlike legitimate cryptocurrencies, OneCoin was never actually mined or traded on any exchange, existing only as entries in a centralized database controlled by Ignatova and her co-conspirators. The scheme operated through a network of international promoters and used multi-level marketing tactics to recruit victims across Europe, Asia, and Africa, with particularly devastating impact in developing countries where financial literacy was limited and regulatory oversight was weak. Ignatova disappeared in 2017 as law enforcement closed in, and she remains on the FBI's 10 Most Wanted list with a $100,000 bounty on her head. The OneCoin case highlighted how modern Ponzi schemes exploit not just investor greed, but also the complexity of emerging technologies and international financial systems. Healthcare and medical investment schemes represent another disturbing evolution in modern Ponzi scheme methodology, exploiting both investor desire for profitable returns and genuine hope for medical breakthroughs. The case of Theranos, while primarily a product fraud, incorporated many Ponzi-like elements as Elizabeth Holmes and her associates used new investor funds to maintain operations while concealing the fundamental flaws in their blood testing technology. However, more traditional healthcare Ponzi schemes have emerged that purely focus on financial fraud while using medical legitimacy as cover. Philip Esformes operated a massive healthcare fraud and Ponzi scheme that bilked Medicare and private investors out of over $1.3 billion between 2009 and 2016. Esformes used a network of nursing homes and assisted living facilities in Florida to submit fraudulent Medicare claims, while simultaneously operating investment schemes that promised returns through healthcare real estate and medical services contracts. The operation involved bribing doctors, recruiting fake patients, and creating elaborate documentation to support fraudulent insurance claims, while using the proceeds to fund lavish personal expenses and pay earlier investors. When federal investigators finally dismantled the scheme, they discovered that Esformes had purchased a $54 million private island, multiple luxury homes, and an extensive collection of expensive cars and jewelry. The integration of artificial intelligence and algorithmic trading claims has provided modern Ponzi scheme operators with increasingly sophisticated cover stories that exploit investors' limited understanding of complex financial technologies. Mirror Trading International, which collapsed in 2021, exemplifies how criminals have adapted traditional Ponzi mechanics to exploit the mystique surrounding algorithmic trading and artificial intelligence. The South African-based scheme, operated by Johan Steinberg, promised investors monthly returns of up to 10% through automated forex trading powered by proprietary artificial intelligence algorithms. At its peak, Mirror Trading International claimed to manage over $1.7 billion in investor funds, making it one of the largest cryptocurrency investment schemes in history. The platform used elaborate trading dashboards and real-time performance reports to create the illusion of legitimate trading activity, while actually operating as a classic Ponzi scheme that used new investor deposits to pay existing investors. Steinberg disappeared in late 2020 as the scheme began to collapse, leaving over 260,000 investors worldwide, with total losses estimated at over $800 million. Investigators later discovered that the supposed artificial intelligence trading algorithms never existed, and that the platform's trading reports were entirely fabricated. Agricultural and commodity investment schemes have experienced a significant resurgence in the post-Madoff era, with criminals exploiting investor interest in alternative investments and sustainable agriculture to perpetrate sophisticated frauds. The case of Lamar Adams and his timber investment Ponzi scheme demonstrates how modern criminals use seemingly legitimate business models to disguise traditional fraudulent structures. Between 2004 and 2018, Adams operated Madison Timber Properties, which raised over $164 million from over 300 investors by promising returns of up to 13% through investments in timber harvesting rights on private land in Mississippi. The scheme used professional marketing materials and detailed financial projections to create the appearance of a legitimate forestry investment operation, complete with maps of supposed timber properties and contracts with fabricated landowners. Adams maintained the fraud for over 14 years by using new investor funds to pay earlier investors while diverting millions of dollars for personal use, including luxury homes, expensive cars, and gambling activities. The scheme eventually collapsed when Adams could no longer recruit sufficient new investors to meet redemption demands, resulting in total investor losses of over $100 million. Court documents revealed that many of the timber properties referenced in investor agreements never existed, and that Adams had fabricated nearly every aspect of his supposed forestry operations. The aftermath of these modern Ponzi schemes reveals the devastating human cost of financial fraud, as victims often lose life savings, retirement funds, and money borrowed against homes and other assets. Recovery rates for Ponzi scheme victims typically range from 0 to 30 cents on the dollar, with the recovery process often taking years or decades to complete. The Madoff case, despite its size and notoriety, has actually achieved relatively high recovery rates of approximately 70%, primarily because trustee Irving Picard has aggressively pursued clawback actions against investors who withdrew more money than they invested. However, most modern Ponzi schemes lack the extensive paper trail and domestic asset base that enabled such recoveries in the Madoff case. International schemes like OneCoin and mirror trading International present particular challenges for asset recovery, as criminals often move funds through multiple jurisdictions and convert proceeds into cryptocurrencies or other hard-to-trace assets. The rise of cryptocurrency-based schemes has also complicated traditional asset forfeiture techniques, as private keys to digital wallets can be hidden or destroyed, making recovery impossible even when investigators identify the relevant accounts. The regulatory response to modern Ponzi schemes has evolved significantly since the Madoff scandal, with agencies like the Securities and Exchange Commission, Commodity Futures Trading Commission, and Federal Trade Commission developing specialized units focused on cryptocurrency fraud, social media marketing violations, and international enforcement cooperation. However, the pace of technological change and the international nature of modern schemes continues to outpace regulatory adaptation, creating ongoing opportunities for sophisticated criminals to exploit gaps in oversight and enforcement. The emergence of decentralized finance protocols and non-fungible tokens has created new frontiers for potential fraud, while social media platforms struggle to balance free speech concerns with the need to prevent fraudulent investment promotions. As long as human nature includes both greed and the desire to believe in too good to be true opportunities, Ponzi schemes will continue to evolve and adapt, finding new ways to exploit technological advances and regulatory limitations. The lesson from the post-Madoff era is clear. While Bernie Madoff may have been the most famous Ponzi scheme operator in history, he was certainly not the last, and the schemes that have emerged since his downfall demonstrate an alarming level of sophistication and global reach that makes his operation look almost primitive by comparison.